Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Hey, Price?
Yeah.
Price, can we just take one step back, Price?
Yeah.
I had a question from Joseph. So when you look at, and you're showing that huge sell-off, which again, halfway through, you said it was going to continue, and you made really a great call. I think he was trying to say, like, in March of '08, you would have been buying a call there, because he asked the question, are you buying a long call or a long put? And you tend to just really be on the trend side, correct?
That's exactly correct. So, like, if I just change I got a lot of markup here, but if I look at this and I say, okay, where am I interested in buying the call? Where I'm looking at it right when it breaks out right there on that blue swatch there, about 102.5. I'm thinking, okay, what type of a call do I want to buy? And that's where I was going to allude to. Okay, if I've got the index at 102.5. I'm thinking, well, what kind of a call do I want to buy? Well, I'm probably thinking about maybe the 101 strike calls, about $1.50 in the money, maybe in the 100 strike calls, depending on, how much time you have to pay, and also how far out do you go. Here, April would be your front month here, and later March, or you could look out to May if you want to give yourself a little bit more room to breathe. Typically, as you can see, these daily chart moves, when you get on a good trend, usually should last several weeks. So, I'm okay if I buy in the money, trading it very short term, 3 or 4 weeks out, if it's a front month situation, or if you're getting real close to expiration, going out to the next month at least. And of course, for more conservative players, you want to go out even further in time. But my general guideline is about the second month out. So, like right now, we've got the June options being kind of the key front month, so I'd be thinking about July options in this kind of if it was happening right now. So as an example of how do you think about this? So let's just say you had an FX vehicle that's trading, say, at $56.60. Let me get a good color on this. So $56.60. You're saying, okay, what do we do? Let's say you're bearish, actually, in this case. And let's say that, you've got about 6 or 8 weeks left. This might have been a few weeks ago. You'd be thinking about June still. But now we'd be thinking about July. But let's just say you've got a couple months out. You're thinking, okay, if I wanted, instead of selling short the currency, which is going to cost you a lot more in margin than just buying the option. That's why I always will tend to side towards buying the option rather than selling short any vehicle, whether it's a currency, a stock, a future. I just much prefer the limited risk of buying the option. But the question is, what type of option? So in this case, let's say the June 60 put is what I'm looking at. Why? Because a 60 put gives me the right, not the obligation, but just the right to potentially sell this underlying security at a fixed price of $60. Well, it's already trading down at $56.60. You can see that the intrinsic value right away is what? It's the right to sell at 60. We could go in the open market, buy it back 56.60, and pocket that $3.40. And then you say, well, why not just go ahead and do that? Well, of course we can't do that early anyway. In the FX options, those are a situation in which they're European exercise at the expiration only. Would they be settled up in cash? But the reality here is that, as you can see, if we look at it and we say, okay, we've got 340 of this is intrinsic. And you have to pay $470 because, why? Because you have time value, right? So you do 340 divided over 470 equals 72% of this option is what we call intrinsic value, meaning that, if nothing else happens at the expiration, it stays exactly flat at 56.60. You've got almost 3/4 of it, about 72% of the option is the intrinsic, if I can spell, intrinsic value. Now, that leaves your other $1.30, which is the time portion. $1.30, I break everything down into percentages. So $1.30 out of the 470, of course, is the remaining portion, which is, of course, 28% of the option is what we call time value. So in that sense, you're saying, look, if nothing happens, that my risk in this situation of buying it in the money is 28% decay, if you will. I still keep 72% of the intrinsic. Now, of course, if I'm wrong and it goes the other way, I've got to have a way to get out of that trade quickly, because I'll have some price risk if I'm wrong. So that's why it's so important, and I'll show you examples of low-risk entry points here. But let's just say that in this case, say you're right and it goes down to the 50 strike. So you drop a little more than 10%. You drop about almost 12% in the underlying. Well, in this case, you'd be looking at what on the option? Down at 50, a 60 strike put is worth what? Intrinsically, it's got to be worth $10 or $1,000 per contract on 100 shares. So the idea here is that, okay, if it's worth at least $1,000, we paid $470 for it. Just before commissions, of course, or any kind of bid-ask slippage, you've got to factor those things in. But just on a gross basis, it would be about 9.5 times better leverage, 112% gain on the put compared to just about a 12% gain on the short, the underlying. So in this kind of a case, you're saying, okay, now instead of scalping for dimes and quarters, I'm looking for multi-point moves, bigger moves that can actually give me much better leverage. And that's why I like to use options buying in these kind of situations. If you're expecting just a lot of chop and not a lot to happen, that's where you want to consider option spreads, whether you do the credit spreads out of the money, whether you do the iron condors, betting on both sides that it's going to stay in a fixed range in between the bands. These things are things you can do. You just need to have a way to manage the trade if it starts to go against you. So, for example, here's the yuck from a prior chart, and you can see that we had obviously a negative trend bias working here, but it had a few periods where it tried to get going to the upside, but the best trends, of course, were on the downside. And this last one we'll just focus on for a second. You can see as it broke down here, it's just starting to break down below that lower acceleration band, and then what we look for is that confirmation point. So it breaks that low when it first goes oversold right there, just a hair under 104, about 103.5, 103 3/4. And then what's interesting is all these little points along the way here where it looks like it's trying to come out of the oversold mode, we call these retests. So the first one happens here right at 104. That's a key retest. If it doesn't close above there, we're okay to stay with that trade. In fact, we'll add to positions when it gives us these retests. The next one happens down here about 103.25. So you can see that it's happening right in here on that next high back there about the second week of March. We get yet another retest, and then this one's going to get taken out finally. That stop would be right around 100, and then you can see the last day on this chart here, that was an exit because it was breaking and closing, not just intraday, but closing above that high. So at that point, we're saying, okay, that nice trend we had from 104 down to about 97, and again, if you can scale out a half of your profits at a double, you can always scale out less than that if you want, but we like to double because we get that free trade back, and then if we don't get it, we just stop the whole trade out. But if we've gotten part of it off and then you get stopped out, you're not looking back in regret. You're not looking back going, oh, well, I should have taken a double on part of the position. I didn't. Now I'm sitting there going, well, it's violated. Well, I'll hope it gets back down there. Well, hope is one of your deadly enemies in your trading. You've got to eradicate all emotion as much as you can. So how do you use acceleration bands and the percent R, the Williams percent R? Do we teach these in our ACE coaching program, ILS? Yeah, I mean, that's where we focus. No matter what the vehicle, IL, that's exactly what we're constantly teaching is these type of specific low-risk entry points on each of these retest points once we're in a defined trend. So that the idea is that, okay, if it's not trending, we're going to wait because there's going to be enough situations across whatever you're trading. In this case, you got multiple FX option pairs that ISE has set up for you across all these key currencies against the dollar against them. And so the idea here is that we're going to look at which one's showing us the best leadership. One of the things you've got to keep in mind, too, is sometimes when the dollar gets really strong or really weak, it's going to start showing you signals across multiple of these charts. And the idea is that, well, then what do you choose if you're trying to focus on one? I would always, if I'm buying it, I would always look at the relatively strongest one, the one that signaled earliest, the one that showed me the most strength, because that's going to have the most power move historically, or the one that signaled the first sell, if you're getting a bunch of sell signals, whichever one comes in there first and then gives me a low-risk entry point, that's typically where I'll focus my capital, because you want to be on the relative strength leaders, up or down, the weakest on the way down, the strongest on the way up. That's where you'll see more accumulation, more flow of money, because that's what's leading the market by definition by giving the earliest signals. So keep that in mind if you're having trouble deciding between various signals.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.